Hello, everyone. I'm attorney Aiden Kramer with the law office of Aiden H. Kramer in Colorado, and you're watching All Up in Your Business. Since I get a lot of questions and a lot of the same questions, I figured I would take a few videos to answer those questions. Most of the questions that I get have to do with single member LLCs. I'm guessing because there are a lot of single member LLCs, and it can be kind of confusing running them because you feel like you can kind of do whatever you want since you're the only owner, but there are still rules and laws that you have to follow. So all of these questions that I'm going to be answering in this video and then a few of the next ones have to do with single member LLC. So the one question that I absolutely get more often than any other questions is, how do you pay yourself in a single member LLC? If you're the only owner, how and when and under what method are you supposed to pay yourself? So that's what I'm going to answer today. So as you can probably tell, I take a lot of pride in the high quality of these All Up in Your Business videos. So in that spirit, I've decided to hire a really expensive, fancy graphics design company to come in and design some pictures for me to help explain how you pay yourself in a single member LLC. So I hope these graphics help me explain that, and I hope you guys appreciate it because, man, were they expensive. The way to pay yourself in a single member LLC is going to differ depending on whether or not you've elected to be taxed as an S Corp. If you're not sure what an S Corp is, go ahead and look back to my video, What the Heck is an S Corp? And hopefully it'll answer that question for you. All right, are you ready for these fantastic graphics? Let's get going with it. Okay, so as you can see here, we have two business owners. You can tell they're business owners because they're carrying briefcases and they're thinking about money. They're both the sole owners in a single member LLC. As you can see in this fantastic graphic, this business owner has elected to not be treated as an S Corp for tax purposes. This one, on the other hand, has elected to be taxed as an S Corp. So as the graphic shows, when you're not treated as an S Corp, any money that goes into the LLC is treated basically as personal income to the business owner. And all of that income is subject to tax at the personal level of the business owner and is also subject to self-employment tax. So because of that, a business owner that's not treated as an S Corp can be subject to a pretty high tax rate. This business owner, on the other hand, since the LLC is being taxed as an S Corp, is a little bit different. The money goes into the LLC, and then the business owner has to take what's called a reasonable salary. The IRS doesn't really give a whole lot of guidelines about what a reasonable salary is, but it's a good thing to talk over with your accountant or with your tax attorney, business attorney to figure that out. The LLC owner gets paid a reasonable salary. That salary is subject to taxes and subject to those self-employment taxes. The rest of the money that the business owner takes above that reasonable salary is as a dividend and is not subject to those self-employment taxes. So if your business is making a certain amount of money, depending on what it is and what industry you're in and how much that reasonable salary would be, the S Corp election could potentially save you a lot of money in taxes. That's the basis between an S Corp and an LLC as far as tax goes. So what does that have to do with paying yourself? Well, I'll tell you what it has to do. Since the business, which is not being taxed as an S Corp, all of that money is coming in as personal income for the business owner. The business owner can basically pay himself however, whenever, and however much he wants to. While that's true, the business owner has to keep a few things in mind. You have to make sure that after you've paid yourself, whatever you're going to pay yourself, the LLC is still adequately capitalized. So this means there has to still be enough money in the business, in the name of the business, to pay for overhead, to pay for debt, to pay for expenses that you expect to have, and to potentially grow your business in the future. So just because your business is bringing in $10,000 a month doesn't mean you should be taking all of that as your personal spending money and paying paying yourself $10,000 a month. You need to keep some of that in the business for those expenses and to grow your business. And you also have to make sure you save money to pay for those taxes, because with the self-employment tax, you're going to be subject to a pretty high tax rate. And so you could potentially have to pay a lot of taxes. So after you pay yourself, you need to make sure you put away some of that to pay for those taxes. So when you are in an LLC and you're not being treated as an S Corp, the way you pay yourself is you cut yourself a check out of the business account, and in your books you would call that a member distribution or a member withdrawal. It's not really payroll, and it's not a salary, it's not deductible like payroll is, so it's really, you want to just call it a member distribution or a member withdrawal, something similar to that in your book. So I will pull back the curtain a little bit. I like to be really transparent with you guys, and I try to explain things as clearly as I can. So in the spirit of that, I'm going to describe to you how I pay myself. I am a single member LLC, and I'm not treated as an S Corp. The reason for that, if you're wondering, is because I've only been in business for a year, and I didn't think that I would be making enough in this year to really justify being treated as an S Corp. So what I do is I pay myself usually 2 to 3 times a month, and how I figure out how much to pay myself is I basically take however much income my business has had in that month or in whatever period since I last paid myself. And just to be safe, I take about half of that, and then I take that as my own payment. I do that assuming I know what my overhead's going to be, and I know whatever expenses I'm going to have coming up. So I make sure that all of those are going to be covered, and then I take about 50%. And then from that, I take a little portion out and put that away to pay for my taxes. And then whatever is left after that is mine to spend on the really important things like food, shelter, clothing, makeup, shoes, trips, wine, all the really good things that you're supposed to spend your money on. So then opposite to that, if you have elected to be treated as an S Corp, like I mentioned, you have to pay yourself a reasonable salary, which is going to depend on your industry and how long you've been in business and all of that, which your accountant will hopefully help you figure out. So you have to take that reasonable salary, and that can be processed as payroll, and then the taxes are going to come out of that reasonable salary, and then anything else that you get paid, you would call that a dividend, and that wouldn't be subject to that self-employment tax. So when you pay yourself as an S Corp, you're going to have these 2 classifications of when you take that money out. You're going to have the payroll, and then you're going to have the dividends, versus just that one member distribution or member withdrawal if you're not taxed as an S Corp. So really, that's it. It can be a kind of daunting idea. How do I pay myself when I'm the only owner of this business? But really, as long as you keep your business adequately capitalized and keep enough money in your business to run and grow your business, it is actually a pretty simple process. So hopefully for all of those who had that question and who asked me that question, I hope that answered it for you. Otherwise, I hope this was helpful, and I hope it helped all you single member LLCs. Thank you so much for watching. I'm Aiden Kramer, and I'll see you next time.